produce very complex end products made of hundreds of components in factories that take years to get online. So unsurprisingly, they aren't really changing anything until they really know what the trade landscape is going to be long term. There are, however, some companies that have ignored this trend, although not exactly for the best reasons. Big retailers like Walmart have significantly increased the amount of inventory they are keeping on hand so that they can keep their shelves stocked more consistently while these trade wars figure themselves out. This might help them outlast their competition by a few weeks, but holding this much inventory is generally bad for business, and there is a limit to how much they can actually keep. Even at their current elevated levels, and even if consumer behavior was totally predictable, their supplies would run out in a little over 4 weeks. The other businesses are mostly tech companies announcing major investments into data centers and energy infrastructure to develop artificial intelligence here in America, and there have been some truly ludicrous numbers being thrown around. Now, spending hundreds of billions of dollars to further accelerate the production of AI slop might not sound like your idea of a great investment, but even if the end product is not ideal, these investments can do a lot of good. All of this infrastructure needs to be constructed by skilled technicians, and even though it feels at least a little bit dystopian that tech companies are onlining their own nuclear power plants to feed their insatiable appetite for energy, that's still going to give jobs to a lot of people in an area that really needs more funding. But here's the thing about big public investment announcements. They're free. The companies making these announcements don't actually have to follow through on them, and in most cases, they don't. Apple recently announced a plan to invest $500 billion here in America, an investment that would also create 20,000 new jobs. This was widely celebrated and supported by politicians who wanted to talk about their business-friendly credentials. But if you've been paying attention, it does sound awfully familiar. Back in 2018, Apple announced a $350 billion investment into the American economy, which would also create 20,000 jobs. 3 years later, after the inauguration of Joe Biden and the news about more regulations on tech monopolies, Apple made another announcement about investing $430 billion in a plan that would, you guessed it, create 20,000 American jobs. Now, Apple is not alone. Most companies do this. Apple is just particularly bad at not even pretending to change their homework a bit. Elon Musk has also built an infamous reputation for overpromising and under-delivering in his business. But love him or hate him, he is basically doing the same thing that every other tech company in America is doing. He is just getting up and announcing it personally. But why do they do this? Well, there are 3 reasons. The first is that it's a great way to get politicians on your side. Lawmakers on both sides of the aisle love a good headline they can post about their booming economy, and big investments that create lots of jobs are exciting to most people. It also lets them push back against any of those nasty regulations. If you are the CEO of a company about to catch the attention of the FTC, you can just call up the politician you have on a retainer and say that if a law goes through or your company gets investigated for anti-competitive practices, you may not be able to commit to the big investments you had planned. And wouldn't that just be terrible? These announcements can also be used to secure co-investments from the government or relax regulations to let these businesses make their supposed investments without getting bogged down by pesky red tape. The second reason is that people just forget about it. Not many people are that interested in the budget planning of large companies over the next 5 years, apart from sophisticated investors who won't really care if the company doesn't blow $500 billion on some PR project and just does stock buybacks with that money instead. The third reason is that it pumps up stock values. Regular investors will see a company making a big investment into a hot new industry that signals that A, the company has $500 billion to invest, and B, the company is optimistic enough about its future to use that money. If companies can give the impression of making big investments without needing to put those investments in their financial statements, that's a big win. The expectation of unlimited future growth is why these companies have become so unbelievably valuable over just the last decade. Picking on Apple again, its profits have only increased by 80% over the past decade, but its valuation has increased by over 330%. We spoke about stretched valuations last week, but something I forgot to mention is that this only works if people expect even the biggest companies in the world to keep growing extremely quickly, which is getting harder and harder. So maybe this market crash is at worst correcting investor expectations, or at best a buying opportunity that will let new investors get access at more reasonable prices. But there are some problems with this idea. The first is that buying the dip is just timing the market, which for most investors is a really bad idea. And you don't want to make the plain bagel angry with bad personal financial decisions, do ya? The wider problem, though, is buying the dip with what? Household savings are approaching record lows, and unfortunately, as companies have to answer to their shareholders, they are likely to continue with layoffs to minimize their expenses during the period of uncertainty. And that's to say nothing of the employees that have been laid off from historically stable government jobs. It might be cathartic to watch the net worth of some of the richest people in the world tank with the down market, but even though they are technically more exposed to the market, they will almost certainly be able to survive economic turbulence better than most households. Some, like Warren Buffett's Berkshire Hathaway, have slowly been accumulating hundreds of billions of dollars in cash. So yeah, old man Buffett is going to have a great time buying the dip. Everybody else? Probably not so much. Now, alright, even if the stock market gets more consolidated, maybe a market crash will be an opportunity for average people to get into something that's becoming an even bigger asset market.